Hello, my friends. Today is March 22nd, and this is Markets Weekly. So last week, the biggest event was Chair Powell, but other than that, markets were pretty range bound. Overall, major equity indexes had some volatility day to day, but didn't really change on a week to week basis. Similarly for rates, similarly for basically everything. Oh, well, gold did get a good bid on the back of geopolitical tensions, but did give some of that back on Friday. And also, it was a pleasure to see some of you at the Digital Asset Summit. Thanks for tuning in. So, today, let's talk about three things. First, let's talk a little bit more about inflation expectations, since that could potentially have some impact on the scope of monetary policy going forward. Secondly, let's talk a little bit about inflation in Japan, because, you know, honestly, it's kind of strange to see Japanese inflation actually higher than US inflation. And lastly, let's talk a little bit about some interesting work from the New York Fed about how consumers are prioritizing their debt repayments and why that suggests that housing boomers are going to be wrong. Okay, starting with inflation expectations. So there's been a lot of publicity about inflation expectations recently because the University of Michigan survey is showing that consumer inflation expectations are surging. Now, this could matter to monetary policy because if you go to economist school, they'll tell you that if consumer expectations are high, that suggests that going forward, we could actually have a higher inflation. The reason being that if everyone expects prices to be higher next year or in the future than today, then they'll start buying stuff today, and that increase in demand will actually push prices higher. Now, this is a totally reasonable sounding theory, but uh, like most economic theories, I don't think it's true. I mean, if you think back about, let's say, the past few years, during heading into COVID, for example, inflation expectations very well anchored. In fact, in the beginning of COVID, everyone was expecting massive deflation. Okay, inflation expectations very low, anchored, and yet we had tremendous generationally high inflation. Okay, as CPI ticked up to multi-decade highs, consumer inflation expectations went through the roof. Everyone was thinking that, man, everything's going to fall apart. We're going to have high inflation for a long period of time. But then inflation came down, right? So you can just immediately see over the past few years, this theory is just not true. But in any case, the central bankers, being classically trained, believe this to be true. And so if they see inflation expectations ticking higher, maybe the Fed won't have as much scope to cut rates to support the economy as we thought. Now, when you look closely at the University of Michigan inflation expectations, you'll notice that there is a huge partisan difference where Democrats are thinking that inflation is going to go out of control, whereas Republicans are honestly looking something close to 0.1% inflation, basically almost deflation. So there is that aspect there that we have to be mindful of. But Chair Powell, looking at this stuff, pushed back against it pretty strongly at his press conference. He's telling everyone that, he's not too worried about these inflation expectations because what he cares about is not shorter dated inflation expectations, it's longer dated. And by his measure, those inflation expectations are well anchored. So what is he actually looking at? So first off, let's look at the New York Fed's own survey of consumers' inflation expectations. And you can see that based on their own surveys, it seems to have ticked up just a little bit, but I would say that it not that much, and you can still say that inflation expectations, longer term inflation expectations, are still pretty well anchored, or at least you don't see that huge uptick you would see in the University of Michigan surveys. Now, looking beyond that, you can also look at market-based measures of inflation expectations, and that's largely through TIPS implied break-evens. Now, if you look at 10-year TIPS implied break-even, you can see it doesn't seem to have really ticked up a bit. I mean, it doesn't really have ticked up at all. I mean, it's very much range bound. So looking at the New York Fed survey, looking at market pricing, the Fed is not concerned about inflation expectations becoming de-anchored. But let's look at some additional data that the New York Fed has also provided. So they've been doing some work, not just on consumers, but also on corporate business inflation expectations. And here you see a familiar pattern. So if you look at business inflation expectations, whether or not they're going to raise prices going forward, in the short term, yeah, you do see that businesses are thinking about raising prices a bit compared to the past. nowhere as much as they did during the pandemic inflation surge. But yeah, you can see some uptick in short-dated business inflation expectations. But when you zoom out a bit and ask them about how they think about the future, you can see very clearly that the longer dated inflation expectations for businesses really hasn't changed at all. So what we're seeing right now in the inflation expectations world seems to be two things. One is that there is a partisan divide, and secondly, uh, the uptick in inflation expectations overall is mostly short term and not long term. And this kind of makes a lot of sense because when you think about tariffs, because a lot of this is driven by perceptions of tariffs impacting the price level. Let's say that you put on a 10% tariff on something, yeah, the price of that could potentially go up a bit. But inflation is not the change in the price level, but the rate of change. So unless you think tariffs are going to continue to increase every year going forward, then you shouldn't expect tariffs to have an impact on the inflation rate. Just a one-time change in the level of prices. And surprisingly, well, to me at least, that it seems like the public broadly understands this, that maybe prices will go up a little bit this year. But beyond that, again, I don't think anyone's expecting tariffs to go up every year. Beyond that, there's not that much of an expectation. Now, given that, if the Fed were to see that the economy weakens going forward, they won't be constrained by inflation expectations in cutting because they think that they are well anchored. So that's good news in case that we do have some hiccups in the economy. All right, the second thing that I want to talk about is what's happening in Japan, because what's happening in Japan is super, super interesting. CPI in Japan is actually higher than it is in the US. Now, this past week, we got the latest Japanese CPI data, and it retreated a little bit on a year-over-year basis, but it was higher than expectations. And it's still, it's historically quite high for Japan. So at this time, the market is actually pricing in, well, many people are expecting more hikes from the Bank of Japan, even as the market is increasingly expecting cuts from the Fed. Now, looking at some of the drivers of Japanese inflation, a big driver is labor. So wage increases in Japan have been coming in pretty hot. This survey from its largest labor union is showing that wages are increasing at about 5% year over year. Now, zooming out more on a macro level, one of the big competing theories about the world is that, as you have demographic aging, is it inflationary or is it deflationary? Now, as I've discussed in the past, I have strongly believed, in line with that really smart person from the UK, that a deflation population aging is actually inflationary, because at the end of the day, when the population ages, you have less labor supply. So thinking about retirees, when they retire, they stop working, but they don't stop consuming. Many of them, especially the boomers, grew up in a world where house prices went up, equity markets went up, so they have a lot of financial assets that they could rely on to continue to spend, go on cruises, restaurants, and so forth, but they don't work anymore, so they don't produce. That means demand for goods and services in the world doesn't change that much, but the supply of goods and services declines. And so as the population ages, labor becomes scarce, wages go up, and that can be inflationary. And that is actually looks like it's playing out in Japan, and that could be a preview of what happens in places like Euroland or the US. Again, it can be short-circuited by, say, immigration policies and so forth. It seems like they are trying to do that. But if they don't do that, and of course, immigration comes with all sorts of other social issues and political issues as well. But if they don't do that, it seems like labor costs will continue to rise, as we see in Japan, which doesn't have a lot of migration. And that is actually showing that, maybe an aging population is actually inflationary. Okay, now, as the market is looking at this, you have this really interesting divergence where two-year yields, again, short-dated yields, are a better view of the expectation of monetary policy than longer-dated yields. So you can see that the Japanese two-year, is staying pretty high, maybe going up a little bit the past week, But at the same time, the two-year yield in the US has been declining as US growth data and equity markets have been disappointing. Strangely enough, though, the Japanese yen, hasn't really been super sensitive to this so far. Um, Looks like it's around 150 right now, but it's been strengthening and then now it's been weakening over the past couple of weeks. So um, that strikes me as something that is a anomaly, and you would expect that as monetary policy diverges going forward. And again, as you all know, I expect the Fed to cut much more than the market is pricing in. I wonder if this currency could potentially be mispriced. Okay, the last thing that I want to talk about is this really interesting work from the New York Fed about household debt payment prioritization. So let's look at this chart that they have here. So one thing that we've noticed is that credit card delinquencies have been rising a lot. But at the same time, mortgage delinquencies have been very low. So as a household gets squeezed, maybe they have, maybe someone loses their job, or maybe uh, they're just falling on hard times, they got doged or something like that. They have limited resources and outstanding bills. What do households do when they are in this situation? It looks increasingly like they are um, lowering the priority in paying credit card bills and prioritizing things like autos and mortgages. And that could be part of the reason why we see credit card delinquencies rise. Now, the New York Fed is looking deeply into this data and trying to figure out why. Now, historically speaking, you would expect, in the US at least, households to highly prioritize autos, actually, above all else. So I used to work in auto credit, and the thinking was that, in the US, you really need a car. There's no really good public transportation. So even if you wanted to buy groceries, or even if you wanted to drive, even if you wanted to go interview for a job, you'd have to get into a car and drive. And at the end of the day, you can always sleep in your car. So it was always thought that people would always, no matter what, repay their auto loans, and that made auto credit a pretty good bet usually. Now, it seems like over the past few months, people have still paying down their autos, but increasingly prioritizing their mortgages. Now, this seems to be due to two things. First off, one of the things that the researchers found is that as house prices surged over the past few years, consumers have tremendous amounts of equity in their homes. And so they don't want to lose their homes, right? So let's say you bought a house a couple years ago, maybe you have 10, 20% equity in your house due to the COVID surge. So, you don't want to lose that. So you got to keep paying your bills. In contrast, during the great financial crisis, say in 2009, 2010, house prices absolutely imploded. And so for many households, the mortgage was actually worth more than the house. And so it made sense to just walk away. That's not the case here. And so everyone is paying down that mortgage to make sure that they can keep that equity. Secondly, and to support that, the researchers note that in zip codes where house prices have actually surged the most, the prioritization for mortgage payments has actually went up more than other jurisdictions. Now, in addition to that, there's also this mortgage lock-in effect. So if you got a mortgage, the past few years, in the early times of COVID, you're sitting at interest rates that could be generational lows, 3%, 2.5% mortgages, and that is super, super valuable, and you don't want to give that up. So no matter what, you want to keep paying your mortgage so you can protect that really sweet mortgage rate. And maybe having a low mortgage rate also makes it easier to make those payments as well. So there is some evidence for that, but not as strong as the equity effect. So overall, what you're seeing is that, a lot of people have been on the internet talking about, the potential for mass foreclosures, big dooming in the housing crisis. But again, oftentimes the future does not look like the past. And given the path of the housing market the past few years, it looks like consumers are holding on to their homes at all costs. So there won't be any forced selling, there won't be any mass foreclosure. And I think that, this housing crisis that some people are talking about is just not going to happen. Again, something else could happen, but it looks like so far that the housing market seems pretty solid. All right, so that's all I prepared for today. Thanks so much for tuning in, and I'll talk to you all next week.